So we've learned the basic principle of how businesses are valued, but there are three basic types of business, and I want to talk through how each one of it is valued specifically. So the three types of business we're interested in are service businesses, asset businesses, and hotel businesses, and they're all valued differently. So the first one is service businesses. So this can be anything from a plumbing firm to an accountant to a coffee shop. Now, this type of business is valued based on a multiple of profit. So let's say your sales revenue was 500,000, you had delivery costs and overhead of 400,000, and this would mean your profit was 100,000. So a multiple is then applied based on how big the business is and how risky the market sees it. And that is generally the value of that type of business. The multiple for a small business typically ranges between 1 and 4 times profit, but you can say an average of about 2.5 times. Next is the asset business, and this is generally businesses that have very low overhead and delivery costs. So property landlords, software companies, franchisors, companies that own lots of intellectual property. And these companies are all based on a multiple of revenue. So let's take the previous example. Let's say it's a property landlord and they get rental income every year of £500,000. That revenue figure is then multiplied by a factor to get the valuation. So different industries differ as to what the multiple is, but generally you could say it's around 8 to 12 times revenue. So for a business that has £500,000 revenue, a 10 times multiple, that would mean that business is worth £5 million. And there are various factors that affect what that multiple will be. The biggest one is how secure that revenue stream is. For example, if the software company supplies to government, for example, the multiple will be higher than if it supplies to 1 or 2 small local businesses. The same applies for the property landlord. If that property is leased to a big international bank, for example, the multiple will be much higher than if it's leased to a local coffee shop. And that's just because of how likely it is that for that revenue stream to continue. Next is a hotel business, and this is a bit of a hybrid depending on the situation. In some cases, especially the smaller end of the market, it might be valued like a service business and have a landlord which pays it rent every month. But due to the high cost of building a hotel and fitting it out, for a larger hotel, say anything above 30 bedrooms, this model of valuation doesn't really work because it would mean a property investor would get less than 1% return on their investment every year from that property rental to the operator. So instead, he uses hybrid model. And that is to value it based on how much operating profit the business makes. But the valuation multiple is much higher than a traditional service business, like we looked at already. But unlike the service business example, this doesn't have a landlord. It doesn't pay rent every month to a landlord. So its profits will be higher. So a hotel owner will own the building, but also the operating business as well. So the valuation will be based on a multiple of profits again. Now, the actual multiple varies wildly depending on how well known and secure the hotel operating business is, where the hotel is located, what's the standard of finish in the hotel. Is it a 2-star property or is it 5-star? So it could be anything from 2 to 3 times profit, right up to 30 times profit. If it's, for example, if it's one of the places in Dubai or Las Vegas, it will be the higher range. Now, there's a few key things to consider about this valuation, though. First of all, is the property up to a new standard, or does it need complete refurbishment? Are there other issues that need to be dealt with, such as boundary disputes? All these things will reduce any valuation. And what about if the business is losing money? And does it have a management team in place running things, or is it reliant on the owner showing up every day? If the business is losing money, it can be difficult to put a price tag on it. I looked at a hotel resort a few months ago. It had been closed down for a year after it went bankrupt, but the actual property needed major renovation work too. So it had no profit to value it against, and it needed a few £1 million spending on it to get it ready for trading. Really, the only way to value a business like this is to look at the replacement cost. For example, if to build the property from scratch, it would cost, say, £1 million. Assuming the building is already in a new standard and is ready to trade, no furniture or fit out needed, then the value would be £1 million. But in this example, it needed major renovation work as well. So the cost of that renovation work has to be subtracted from that £1 million figure. And if it needs demolition, it's really valued at the land value minus the cost of demolition, which we'll look at in a minute. To get it up to that trading level, if it's not been trading, you'll need to invest in things like marketing for the business. So again, this has to be deducted from that price as well. This is really about starting with that finished value and then subtracting the cost of replacing those missing pieces. Now, obviously, there's also the other issue of risk. If the business is already trading, then there's minimal risk. But if you're setting this up from zero, or you're fixing a business that hasn't been trading for 2 years, then there's a lot of risk there as to whether it will even reach that forecasted level of trading. And with high risk, then high reward also has to be factored into the price. So how much of a risk factor needs to be factored in? Well, if I get an investor to buy a hotel with this level of risk, they're going to want to see a big return on their investment just in case it doesn't work out. They might want to double their money. They might want to triple their money. It all depends on the individual project and how they perceive the level of risk. So this has to be factored in as well. Obviously, this is all just a guide, and it's down to negotiation between the various parties involved. But that's a general guide to how you value the 3 types of business. If we look at an example of a hotel or any building that needs to be demolished, perhaps there's something structurally wrong with it, or maybe it's just not fit for purpose anymore. You really have to start with the land value and then subtract the cost of any demolition and clearing costs for the site. In this case, it's about taking it back to that bare land state ready to be built on again. And I've seen examples like this where a property has been damaged by a hurricane. The government has purchased the property, but then they've had to pay a developer to take the site over. So essentially, the developer has been paid to own the site, although they obviously need to pay for the demolition and clearance of the site from that point onward.